But first, what is an option? It is a contract. So you're agreeing with someone that is selling you these things, and it allows you to buy or sell 100 shares at the strike price of the option. So a call option with a strike price of 100, you'd be able to buy 100 shares at 100 until the expiration date. So you can think of options kind of like a coupon of sorts, where it's like, well, if you come and buy before, let's say 8/16, you can buy this 100 shares at this specific price. So you're pretty much paying a premium to be able to buy or sell shares at certain prices in the future. And then a put option, strike price of 100, would give you the ability to buy and sell 100 shares at $100 until expiration. So you can see you get a strike price. The break even will be above your strike price on a call option. You get your strike price here on the put option. Your break even will be above your strike price. Or wait, sorry about that. Yeah. So your break even will be above your strike price on the put option if you're buying the contracts, which is what we're talking about. So these contracts are bought and sold by traders because they have an exponential return, which also means they have exponential losses. So when trading options, you have to be correct on the move. So when is it going to move? How far is that move going to go? And then how fast is it getting there? Which is why the strat's so good for this, because the continuity, if it's long green bars, you know it's going quickly. If you gauge magnitude correctly, you know where it's going. And if you understand continuity exhaustion, where they open and close new continuity levels, you know how long you have until things change and you might have to close, or until that continuity runs out and it's going to have to reconfirm. This is what makes options trading inherently harder to do, especially with standard technical analysis. Because if you're doing like, oh, I'm going to draw my wedge out and then I'm going to get this breakout and I'm going to buy weekly options, and then it breaks and it doesn't go anywhere, but you're still like, well, it still looks good, and then it breaks and goes nowhere and it's going sideways, and then it closes sideways and you just lost all your money. That's where the problem is, which is why we always say we need twos. We need to trade twos. We want more twos in our favor than not at all times. And options are priced per share. So if a contract's trading at $1, it's worth $100 because it's $1 per share of the 100 share contract. So next, there's two types of values that an option will have that determine the price you have to pay. And the price you pay is also called the premium, because when you're buying these things, they're always trading at a premium. Because if you buy an option that's $1 in the money and it expires 2 weeks from now, you're going to pay more than $1 per share, even though it's only worth $1 per share. You're always paying more than the option's worth. So the first type of value is called extrinsic value, and it's determined by other factors outside of the current price of the stock. So the main two factors calculated are here. So the first is theta, which is how long you have until it expires. So the more time until expiration, the more theta value a contract will have. So if you've ever heard someone talk about options and mention theta decay, that's what that is. Because as time goes on, your option becomes worth less. Because if you can buy 100 shares at $100, and you can do that, let's say 6 months into the future, and the stock's trading at $100, they might price in $13, $14, $15 of upside on that option contract, because whoever's selling it to you also has to make money, right? Now, if you're buying that same $100 contract, $100 strike price, and it expires on Friday in 2 days, well, at that point, that contract might be worth 50, 60, 70 cents, depending on volatility, maybe a couple bucks, but it's not going to be worth 12, right? So depending on how much time the contract has, the more it's worth. The same way, if you went to Starbucks and you're buying gift cards and they're like, well, we'll sell you this $100 gift card and it never expires, you might just pay $100 for it, right? But if they're like, well, we're going to sell you this $100 gift card, but you have 4 hours to spend it, it's like, well, I'm not going to pay as much for that. I'll give you like $80, right? So time value is important. The second thing is implied volatility. So this is the expected future price movement or future volatility of the underlying stock. So if it's like let's say it's like, what's been moving around? Let's say it's like end phase, right? So end phase just moved 10% in a day, right? So if it's moving plus or minus 10% a day, those options will be worth more due to that implied volatility where it keeps moving really big. So they're going to price in the moves before they occur. So like right now, if we looked at the end phase 120 calls, although they're $5 out of the money, if we even looked at this week's expiration, so if we're looking at the 120 call, notice how it's worth $1.20 right now, right? And it's $5 out of the money. So if it goes to high a day, it would have to go to high a day plus another $1.20 for you to make money, because that value that you're paying for it here is how much it's got to be worth before it expires, or else you don't make money. So this is going to be pretty expensive due to the volatility we've just had. You're going to have to pay more for worse contracts, so they're further away from being in the money. Hopefully that makes sense. So when we look at a premium, you're going to have an intrinsic and extrinsic value. The extrinsic value is going to be the theta, or the time value, plus implied volatility. And we already said this, but premium means how much you're paying for the contract. Every options contract will trade at a premium or a higher price than the current value of the contract due to how extrinsic value is calculated. The next one is intrinsic value. This is the most important one to us as straters, and it's the second type of value an option price is calculated by. This value is calculated by how in the money a contract is. Meaning if your call strike is $5 below the current price, you're $5 in the money. So if you have a 100 call and it's trading at 105, you're $5 in the money. And that does not change. And same thing with the put strike. If you have a put strike at 100 and it's trading at 95, you're $5 in the money. Does not change. So it's always a 1-to-1 ratio, which is what helped me figure out how options can be used to trade. A lot of people don't trade them because they don't recognize this. So since this is calculated, it's very important to know it allows you to define your break-even price of an option based on how in the money it must go for you to make your premium back. It's also very important because it allows you to determine the intrinsic value of options at specific prices, and therefore determine if the options are underpriced for the expected move or pricing in the expected move via the strat concept with magnitude. So you can see extrinsic value. This is the theta and the Greeks and everything that everyone's worried about. I'm worried about this. This is the one that pays you. Extrinsic value does not pay you very much unless there's a crazy news thing or something going on. We don't care about that. We care about intrinsic. And most people miss this. They look at this part and they're like, I have to look at all these 10 Greeks and blah, blah, blah. It's like, no. This part right here is the most important part. So as far as application goes, it's very straightforward and it should make sense. So if we can identify the magnitude of our signals via pivot targets and reversals with, like a 2-2 has a magnitude, right? Or a 3-2-2 has a magnitude. We can compare the option premium that we would have to pay to the intrinsic value of that option at the magnitude. So in this example below, you'll see Upstart. This is one we were looking at today from the chat that was mentioned. I don't know what contract I traded, but I'll pull it up after this. So you're going to see we have inside day Upstart, and this would cause the shooter weak, which I don't have displayed here, but it causes a shooter weak with a magnitude way down there. And you have 4 nearby daily pivot targets. So if I zoom in, notice 1, 2, 3, 4 pivots. This is the pivot machine gun, where you got multiple pivots lined up right in alignment with each other. That's why you can expect boom, 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 take them out. And now notice we have no pivots here. So we can expect this move. And then after that, we don't know. It's got to stay down there, right? So we want to make our money here, become in the money. And then if it keeps going, we're in the money. So each dollar pays us $100 per contract, right? What a lot of people do is they'll say, oh, if it's going to 25.53, I'll buy the 24 put. It's like, no, buy the 26 put or the 26.5, be in the money, make your premium back, and then you can let it go if it keeps going. So if it's a move from 27.25 to 25.53 for the initial break with the initial pivots that we'd look to take out, and we then have a broadening formation to 21.26 if it really gets going. So given those targets, we want options that will be intrinsically worth more than we paid for before 25.53 or at 25.53. So we can look at the 26, the 26.5, and the 27 put strikes for this week. We can also go further out if you'd like, but then you're paying more for theta. And then at magnitude, we can suggest like how much intrinsic value would there be on those contracts. So when we look at the 27 put this morning, it opened at 81 cents when it took yesterday's highs on that second 15, which caused this move on the day, the 3-2-15, I believe. So when this is trading 81 cents here, If this trade works, this will go from 81 cents to being $1.50 in the money. So notice at magnitude, we are in the money and we're above our break even price, because the break even is the strike price plus how much you pay, or minus how much you pay, depending on call or put. So in this case, it'd be a 27 put minus 81 cents. That's your break even. So 26.19 is your break even price. 25.53 is well past that. So we can buy at 81 cents. It trades 2, doubling, and now in the money. So you can have a break even stop. Because it's worth $1.50, it will never trade below $1.50 no matter how sideways it goes until expiration. And this is the thing most people miss. Most people buy out of the money options, try and take them at the money, and then once they're at the money, they put stops break even, then they get stopped out because they're not in the money, and the theta value quickly decreases as you approach expiration. So we want to be in the money before expiration, because then we can hold, and we can treat this like a position of shares. We can say, Upstart 27 put, we have 100 shares at $27 for every contract we own. And if it's in the money, those shares are making us money right now. So hopefully that makes sense. This is how you use the leverage of those options to have gigantic share positions without using a lot of equity or having a lot of equity. The other thing you could then look at is the 26.5 put. Slightly more out of the money, which makes it more risky, as potentially maybe it takes a long time to come through these pivots and that would expire worthless if it didn't get there. But if our target is 25.53, the 26.5 would be worth $1 intrinsic. So at the open, we can see how much was it trading for. 54 cents on the 2-2-day reversal. So this reversed on the day, 54 cents. At the magnitude here, it'd be $1 in the money. So this would go 54 cents to $1. Now, this is one thing you'll want to note. Did it go to $1 or did it go to $1.50? It went to $1.50. Why? Because this happened so quickly, the theta value of this contract did not go down. Therefore, you spent 50 cents on your theta / extrinsic value. It goes $1 further in the money. So therefore, it's worth $1 more and it's trading $1.50. That's how that works. Now, let's say this took all day. So it's slow grind all day. Maybe instead of hitting $1.50 at the highs, maybe it only goes to like $1.30 or $1.40. And you lose 20 cents of that or 10 cents of that intrinsic value. So when things occur matters, and how fast that thing occurs matters. So the closer to the money options will be inherently less risky because you have more extrinsic value that is less likely to wither away since they're closer to being in the money. And the further out you go out of the money, the quicker those moves have to be and the less you can hold through drawdown because you're not going to be in the money as soon. So the whole goal, just to recap, find the setup, identify your pivot targets, say, well, if this works, these 3 or these 2 or these 4 pivots or this weekly magnitude, that's what I'm looking to take out. Then you look at the options chain and you say, well, these close trading at $1. If it goes to this target, they're worth intrinsically 3. That's a good trade. The other type of trade there is maybe your target is to move $5 and you have to pay $5 for the contract. What does that mean? Does not mean you can't trade it, but what it does mean is you're paying $5 of theta value. So as time goes on, you're going to lose that $5 over time. So you want it to move in the money and get moving quicker. You don't want to hold on to that option till expiration unless you're well above your break-even price. So hopefully that makes sense. But what this allows you to do is buy cheap options and make them more expensive because you're buying, in this case, you're buying a consolidation break down, pivot machine gun through these guys, and it does not price in the move. Therefore, it prices in the move once it gets to it because now the move has occurred. It can price it in, and you got it before that shit was priced in. Forgive my French. Before that was priced in, and therefore you can have break-even stops. Intrinsic value, it's the difference between strike price and the value of the stock. If it's a call option, the stock needs to be above, and then it's the difference between those two. If it's a put option, the price of the stock needs to be below, and it's the difference between those two. But this is how it works. So this morning, we're kind of just pointing out the fibers in force, still at a magnitude. So I pretty much got it like right up in here. I just smacked it there. So when I do that, my stop at worst would be the fiver going out of force, but really realistically, I'm keeping it pretty much where that daily open is / like slightly above it because I just use tight stops. You can't stop me. So once this works, it makes low a day. My stop is not on the option contract because the option at this point, I'm not sure what contract it was. Let me check. So at this point, my upstart 27 put, it has gone in the money, but only by 20 cents, right? So down into here, it's only 20 cents in the money at 26.80. So let's say it were to spike up, but not hit my break even. There's a chance that since that intrinsic value diminished and it's gone once it hits 27 here, that the option will spike in the opposite direction and go much lower than my entry price, although the stock price has not traded above where I got it. Does that make sense? So like when intrinsic value disappears and it goes out of the money, you have exponential loss of the option value. So like if we're looking at the 27 put this morning, so if we're looking at the options this morning, let's say we take it short when it breaks. We'll just say this is where I got it. It breaks. The 27 put goes in the money here. And then once it comes back above that, even though it's below where I got it, since it's back above and no longer in the money, the option price at that point can actually come back way above where I entered in a big spike. So you're going to be risking slightly more. That's just how options are, though. The spreads are going to be bigger because it's 100 shares. It's leveraged 100x, right? So the spreads, you might look at it and be like, that's a $50 spread. It's like, well, that's $5 or not even what? Is it $2 a share or something? Yeah, so 50 cents a share. That's not that bad of a spread, right? But it looks bad because you're not looking at it as if it's 100 options or not 100 options, 100 shares that you're playing with. So I would not want to break even on the underlying of that option value. I want to break even on the underlying stock. So my break even goes where I got it, because as long as they're hitting the bid below where I got in, that's fine, right? If it were to come back where I bought it, then I would get out. Maybe it's a 15-20% loss. That's fine, because when they win, it's not a 15 or 20% win. It's 130, 140% win. Even though it's pulled off the lows right now, it's up 115% still because it's so in the money. So you break even using the underlying stock. Then once you're in the money, you can go in profit stops or break even stops on the underlying or on the contract value, if that makes sense. Yeah, no, and this stuff is very important because you can have all the right trades, trade all the right stuff that we're trading. If you're buying like 24 puts on Upstart, maybe you make money on this, but long term, you're going to get murdered. Because the second it breaks down, let's say it reclaims the lows really quick on a fiver, those things go 50, 60, 70% loss instantly. And it's like you're going to get killed doing that. So we want to buy like slightly out of the money and then let it go in the money, and then we can add on that position if we're looking to. The other thing I did not cover was expiration. So you have to think in your head like, well, if this works, do I want it for longer, right? So like if Upstart works here, do I want to hold it longer than next week? It's like, well, maybe it takes a couple weeks to get down into these guys, right? So what I could do is I could take those weeklies up in here, make that 100-something%, take off half, or let's say I take off 80% of the weeklies, take some of that profit and put it into next week's or next month's to give myself more time. Or right when that break occurs, since we're reclaiming all this stuff, I can say, okay, right here, I'm going to buy 3 weeks out and just give them enough time to get to the other side of the try. The biggest thing people mistake on this is when this 2-2 week occurs, it does not have to hit its magnitude that same week. A lot of the time, it can run out of time, meaning this week closes like this. Now, if it goes 2 down again, this 2-2 week pattern is still occurring because it reconfirms it's 2 down. So remember, we're always identifying conditions. It's like, okay, this is 2 up, this is 2 up, this is a shooter, this is a 2-2 reversal after a shooter, and therefore we're 2 down. And then if it stays, it's like, okay, we're still 2 down, we're still 2 down, we're still 2 down. It's still going to go there, right? It might just take some time. Now, when does it go instantly and it just takes them all out right away? That's when you have the simultaneous breaks. That's when you have really long green bars and long red bars and continuity, multiple signals, all of that stuff. So when we're looking at like the financial trade that we mentioned, I believe it's a week, what was it, 2 weeks ago? So we're looking at the inside day financial. Are we going to expect it takes this out the same day we take this inside day break? Probably not. It might take a little bit. But we can buy 2 weeks out or a week out and say, well, I'm going to give them enough time to get up there. And then if they keep going, give them enough time to keep going too. And it depends on the trader. Some people will just take that little gain and be like, I'm done. We really shouldn't, though. We should let the winners go. So we're looking at the JNUG puts. It looks like these are actually kind of illiquid. All right, I guess just for example's sake, we'll just make something up here. But okay, let's say JNUG, right here, the 44 puts. They'd be in the money down here at 44. Let's say they're trading at 30 cents. It's like, okay, well, if they're going to have to go to 42.70 for our magnitude, they would be how far in the money? $1.30. So if I pay 30 cents and it goes $1.30 in the money, you make $1, right? Your break even's 30 cents below 44. But I just look at it as a percent. So I just say, well, if it goes 0.3 to 1.3, then I make like 3x, right? So 0.3. So if I go 30 times 3, 90 times 4, 120. So 4 times the option value, but 3 times return, right? So I just look at it like that. Because if you can look at it like that, then you can be like, well, if I throw $100 in there, then it goes 4x and make 400. And you can quickly do that math in your head, super easy. Unlike everyone who uses all these Greeks and stuff, and they're like, well, the theta and the IV and the this and the that, and it's like the interest rates. And it's like, bruh, if it goes in the money, it's worth that. That's it. Yeah, so this is the thing though, is the further out of the money you go, the further the stock needs to move for you to actually make money. Like if I was trading Tesla today and I traded when that fiver broke in the morning, if I was trading here and I'm trading the 210 puts or something, down here, the 210 puts, they're probably worth 3x, 4x, maybe, right? But if I go and trade the 220 instead, maybe it's only like 2 or 3x, but it's in the money, which is what we're looking for. Because if that 210 put goes here, and then you're like, all right, I'm going to walk away, I'm going to put my stop break even, it's going to come here, stop you out, right? And then it keeps going. So if we go in the money, we're going to have the 220 put, which it does go slightly out of the money here. But if we go 220 put, get it up in here above 221.59, that's when that, or 221.50 when it broke. Get the 220 put, it goes $5 in the money, so we made $5 a contract without even looking at the options. I know it went plus 5 from here. Maybe it went slightly more with IV and whatnot. But once it's plus 5 down here, if I have 2 contracts, I can take one off, then I just pocketed $500, and that means my break-even value on this trade is not here where I entered. It's actually it'd be $2.5 above that. Let me think. No, it'd be, yeah, so about $2.5 above that. So instead of getting in here like this, instead of getting in here like this, and then putting my stop even and walking away, and then it stops me out here, I can get in here, make the 500. Maybe the 500 profit I had before does come back, but I have that position still, and my stop can be high day or the daily open. So I can create a winning position, make my money, leave the open position. And if you do this on enough stocks intraday, at the end of the day, the ones that come and take your break-even stops, you use their money, right? You use their money, you risked their money on the trade, and you lost their money. You didn't lose yours. And then the ones that keep going, you're in. And this is the thing a lot of people miss. They'll be like, oh, like I took it, and then it worked a little bit, and then it stopped me out, and then it kept going. It's like, well, there's 2 ways to get around that. Either get good at identifying the triangle out, where they come up here, stop some guys out, and then reverse. If you got like a 60 in here, there's your 60 down, triangle out, and then back down. Or get good at creating that winning position and then walk away. Because if you can walk away from the screens, you'll never miss anything as far as things that really get going. Like if you bought end phase this morning, anywhere on those 15s or 30s, maybe you set the alert for here and you took your partials and whatnot, but you leave it because you just made all your money and you still have an open position. So it's like you get to have your cake and eat it too, if that makes sense. So the SPY example. So this is another important thing. Our targets or our magnitudes are these pivot targets down in here. So these are coming from the weekly because we have the 3-2 expansion week. We're looking for weekly pivots because the week is in force 3-2. So all these targets below us, these are what we're looking to take out. So we're not only looking for 542.52, we're looking for 541.62, we're looking for 539.59. But what we're trying to do is create a winning position where we have in the money contracts before any of these targets. So that's why I'm pointing out this pivot specifically. And this is the other really big thing is if you're trading out of the money, you need moves that move quickly. So when we point out and we're like, this is PMG, or this will trigger this, will trigger this. Whenever you hear me saying anything like that, that's the ones you want to be on, right? Because if you're like, well, if this 15 triggers the 30 and 60, then you just reversed the 15, 30, and 60 group at the same time. It's a PMG of triggers, which is why PMGs work. So like if we go to semis, we talked about the semi PMGs on the week here, and it's reconfirming. So where's it going? These guys. We want to come after them. So once we start gunning through here, this is where the volatility will increase in speed, and we can factor that into when we're looking at options. We can say, well, if we're 239.02 and we get a 60 signal, we can say, well, I can go and look at the 235 put because 234.26 and 230.89 should get taken out next together. So using the pivots, you can increase how far you expect it to go and how fast you expect it to go. Kind of like the GE the other day. When you see they have 1, 2, 3, 4, 5, 6 weekly pivots to take out on the weekly time frame, that takes out a lot of guys, right? So in the morning, when this goes hammer fiver, not only are you looking at high day, you're looking at this pivot up in here too, and then you just took out a lot of shorts, so potentially keeps going, and it did. I guess this is the last thing I can add to the options thing. So when you're intraday trading, the extrinsic value, or not extrinsic, the intrinsic value is not going to be as powerful as a metric to track and figure out which option you're going to trade. What you want to do is, like, let's say you're trading NVIDIA, you're trying to create a position here. You just want to go closer to the money. So if we're looking at like a 15 rev strat for the outside 60, like a 116 or one at the worst, like 115.5 put, that'd be about it. Like we don't want to go options outside of this range that it's been trading in. So you don't want to go and buy puts that have a strike way below low a day, although you can. We'd prefer to have it in the money before that. So like a 116 put, if we were to had taken this, would have been probably what we'd want to go after. And that's simply because these intraday moves, if this works, makes low day and starts coming back up, and you're really out of the money, you can't hold that position. Whereas if this works, makes low day, comes back up a little bit, but you're in the money still, you can hold that a good bit longer. The only thing is like the intrinsic value versus extrinsic value, your break even. Let's say we're trading a 116 put, your break even will be well below this low a day here, more than likely. So that's where the higher time frame magnitudes come in if you're gonna try and create a position and then hold through the overnight or swing or whatnot. SPY, there's your 30. So let's say we're trading the SPY 30 that we were talking about with the 543 put. Our stop would have to be in here, 543.81, or at the open, 543.92. Now, if you went break even on the underlying or on the options price, notice the spike up in here. That could stop you out. And maybe we can look at the contracts and see. So this one breaks the 30 at around 50 cents. We're looking at it like 52. Trades all the way to 70, right? And then notice how it comes back all the way to 60. It's because if we look at the SPY, this is not in the money. So do you see how that big pullback happens? And if you're break even, you could be stopped out of that stuff. So in this case, it's like right around here, we're talking about it like 52, 53. Does go about 10 cents lower, then 70 cents, and then pulls back almost what, 10, so a dollar. SPY is still under the previous low a day. So your risk has to be wider, and then once it's in the money, then you can start going break even, tightening stuff up, maybe reduce. And the other thing you can do is when we talk about reductions, even more important intraday, if you're going to be a day trader, when this goes low a day, what you can do is you go in here on the 1 minute, and maybe you make your 52 to 70 something cents. Once this goes green, 2 here, reduce by over half or by half. Now your cost basis can be above your entry price. So instead of your cost basis being 53 cents on the option, maybe it's like 40 cents, right? So you can widen the stop and give them room, creating winning position and then doing that. In this case, we'll have to see it starts coming back in. So we'll have to see, does that, 5 minutes, new 60 flip, does it become rev strat and counter this break? Where then you'd have to try and take the other way and take their money back? Or do they go 2 down again? If you're on the 5 minute, They're inside of 5 or at the lows. You can see your 5-minute try looks like this. SPY also reconfirmed the 30s down. So if you're a 30 guy, good, right? And now it's trading 543.11. So notice how this is occurring kind of slowly, right? Does not mean it can't occur before the close. We'd still pretty much expect this stuff to get taken out, 541.61 before the close. More than likely we'll do that on SPY, and then we're exhaustion risk on the week as the next pivot is much lower at 532.05. So when we're looking at this, that try is expanding. When this 15 goes into expansion, we take out these pivots. So they're trying to do that right now. Should cause things to try and speed up. If we go and look at the options contracts we were mentioning before, as far as just talking about this, you can see now they're trading up at 85.90 cents. Notice how they move much quicker now. Why does this happen? Why does the price move quicker as it works in your favor like this? Because you go in the money. And then once you're in the money, it's a one-to-one relationship with price, where every penny SPY goes up, you make a penny. So as long as SPY moves up another dollar or down another dollar, this should go up another dollar. So when we go to SPY here, what we're going to see is they expand the try, boom, causes expansion of the range. Now, 541.61, when it hits that, you're going to have an intrinsic value of $1.40, just about. And then since it expires today, if you held that to the close, it would be trading $1.40 at the close. And if it does it before the close, let's say it does it within the next 15 minutes here, they'll be trading, because right now they're 40 cents in the money trading at $90. They still have about 50 cents of extrinsic value. So you could have your $50 plus $1.40. So they'd be worth just about $2 down here at 541.61. And even if it, and this is the more important thing, since it's in the money now, even if it doesn't do that, you're almost double, right? 52 to 92. That's almost a double. So if you're a 0 DTE guy, you can buy, let's say you got 5 contracts, $250. Maybe you're risking 100 or 80, something a little bit bigger. It's intraday and 0 DTE. Then once it's down here about 100%, you can take off half of those and let the rest ride into the close. Like if they're just going to puke with no reversal, you can hold. But if they start reversing, partial half and then leave the rest, you paid for them. And it just depends on the trader. Some people will get out at 100% and then leave the rest. Other people will try and hold it as long as they can, which is more my prerogative as I've sat here at the charts most. But right here around 90 cents, if we're going to do a partial, you could do it there. And this is the last thing. Everyone always asks me about spread. So like, Alex, the spread on this option is 20%, right? It's like, why are you touching that? The reason you can is because what we know about intrinsic value. The spreads could be 100%, right? But if your option is $5 in the money, you can sell it at 5 and it will always be filled, because they can arbitrage that, or maybe it sells at 490 or something. They can arbitrage that by executing the option, making $10. So they're always going to give you liquidity at intrinsic value. So when it comes to do you have liquidity or not, doesn't quite matter if you have intrinsic value. As long as there's some type of trading going on in those options contracts, even if the spread's 30%, as long as there's a dealer there willing to fill orders, they will fill you at intrinsic value or slightly below it. So if you know that and you look at something, you're like, wow, like if crowd goes 3-2 week and goes outside month, then these options go 10x. It's like, okay, I don't care if it's 30%. I'm going to take it either way. Because if they go 10x intrinsic, then they're worth that. Doesn't matter how bad the spread is. So that's a super neat thing as well. And here you can see SPY on the 3-1-2-1er. If you're an intraday guy, you could have played that, but down they go, 542.52, taking out their stops. And that's why you see that price speed up as they go through the pivot. Looking for 541.61, and those contracts should be a nice, they're already a nice double. They're 52 cents to $1.20. So hopefully you see how that works. Now, can they go to 2 is our question. And this is just such a good example of what we're trying to do with the intrinsic, extrinsic, and gauging magnitude using those signals. It's awesome.